Well, the last section in Chapter 10, dealing with journalizing transactions, is on page 240, section 10 or Chapter 10-4, journalizing other transactions using a general journal. So far, we've talked about purchases. Purchase merchandise on account is always going to go in the purchases journal. Anything that we pay cash for is going to go in the cash payments journal. And finally, anything that cannot be put in any of the other special journals is going to go in the general journal. So there's 5 total special journals that we're going to use in a partnership. The other 2 that we haven't talked about yet that we'll get into in Chapter 11 are your sales journal, which is going to be anytime you make sales, and also the cash receipts journal, which is anytime that you receive cash, okay, from people that we've sold merchandise on account to. General journal is going to look just like you remember in chapters 1 through 9. You have the date column, account title. There's always going to be 2 accounts affected in a general journal, unlike the special journals where they have those special amount columns. So anytime you record in a general journal, there's always going to be the first entry of the first account and then indented the second account. We have the document number, our post reference for when we post to the general ledger, and then we come back and put the account title or account number in this. General debit, general credit column. Again, you're always going to have a debit, always going to have a credit when it comes to recording in a general journal. So let's take a look at the first transaction now. It says buying supplies on account. Now you're seeing this and you're thinking, well, wouldn't this go in the purchases journal because we're buying something on account? The only time we're going to record anything in the purchases journal is going to be merchandise on account. Merchandise being things that we're buying from a vendor, and we're going to mark up the price and sell to customers or other businesses so that we make a profit too, being a middleman. So we're just buying store supplies on account. It's not merchandise. That's very different, and you need to make sure that you know that. So we're buying store supplies. It says November 6th. We bought store supplies on account from Foxfire Supply for the amount of $210 with memorandum number 52. So remember that the source document is M. If it's a memorandum, it's M52. The debit amount, which again, it's an asset account. We're going to increase our assets. We gain something. It's worth something, even though we're probably going to use it. We're going to increase our asset account, and then we're going to credit our accounts payable Foxfire. Okay, we have to put accounts payable here because there isn't a special amounts column that says accounts payable credit. Accounts payable credit means an increase. That means we owe them money at a later date. It increases that account, which is normal credit balance for any accounts payable. That means we owe somebody money. So here's the steps here. Write the date, account title, we're writing the source document number, the debit amount. We're going to come down, we're going to indent the credit account, which is accounts payable Foxfire. And finally, we're going to put the credit amount here. One thing too with the it says place a line, diagonal line, in the post reference column of the accounts payable account, and we're going to talk about that in 2 more chapters when we start posting. So for right now, put that diagonal line or just leave it blank. The other account, or the other transaction that we're going to talk about real briefly, is merchandise withdrawal by a partner. Now, for the most part, if you're a partner, you're going to withdraw cash. You want cash. You want the company to write you a check for your profits. There are certain circumstances where the partner might withdraw, instead of cash, might withdraw that merchandise. Well, that merchandise is still personal use. It's going to come out of the drawing account. So it's just like a cash withdrawing merchandise, or I'm sorry, withdrawing cash for personal use. It's kind of the same thing, just another account is affected. Instead of crediting cash, we're going to credit purchases, which decreases our purchases of what we have on hand for our inventory. So we're going to Carl Cohn drawing. It's a drawing classification account. Purchases is a cost classification. It doesn't go under assets, liabilities, or owner's equity. It goes under these classifications. You can see the change here, the increase our drawing. We're going to decrease our purchases. We no longer have that inventory on hand, which is a debit and a credit. And you can see here, again, as you know, a drawing account carries a normal debit balance on the left side here, and purchase account carries a normal credit balance, or I'm sorry, normal debit balance as well, but we're decreasing what we bought. We're decreasing our inventory. Instead of withdrawing cash, we're actually withdrawing some of that inventory, okay, for personal use. And here's how you record that in the general journal. Again, we're going to write the date. We're going to write the account that is affected here, which is drawing. Source document is a memorandum 53. And remember, a memorandum is going to look something like this. Has the number here and the date. It says attached invoices for store supplies bought on account. For this memorandum, when you're withdrawing merchandise, it might say, Carl Crone withdrew merchandise for personal use. Memorandum 53. Debit the drawing account 300. We're going to credit the purchases account or decrease the purchases account by $300 as well. Here's 10.4, work together. You see WT 10-4. If I turn to that, that is on page 243. The first transaction, first of all, it says make sure you use page 8 of the general journal. Make sure you write the date and the year, current year. On the 5th, we bought store supplies on account from Designer Supplies for $180, the memorandum 62. So we're going to debit store supplies, memorandum 62. We're going to credit accounts payable Designer Supplies that amount to. We owe them $180 at some point. The next one is basically the same thing, except instead of store supplies, we bought office supplies from Carousel Office Suppliers. It's the same transaction. Two different accounts affected though. One is asset supplies store, one is asset supplies office supplies. We owe these vendors at a later date, so we're going to credit their account, which again is a normal credit balance liability increase. On the 9th, Stephen Cafaro withdrew merchandise for personal use. Again, we're going to put the memorandum 64 as it tells us the source document. $95 is debited to the drawing account and $95 is credited to the purchases account. Both carry normal debit balance, but we're decreasing our purchases, our inventory. Same thing, except Consuela, who's the other partner in this business, withdrew $225 worth. So maybe there's a difference in what each partner owns as far as a percentage. Maybe Stephen Cafaro got paid cash to the equivalent of $225. Really not sure the situation, nor is it any of our business. We're just the accountants. They're the business owners. They withdraw what they want. It's their profit and loss. We're just there as consultants. So that takes care of Chapter 10. Again, just to kind of summarize a little bit, let me bring a new slide here. Summary of Chapter 10. We talked about the purchases journal, which are only merchandise sold or bought on account. Also talked about the cash payments journal, which are only cash payments. And finally, the general journal. Any transaction that can't be recorded in a special journal. Altogether, we have 5 journals. In a partnership. Next chapter, we again will talk about the other 2 journals, the sales journal and the cash receipts journal. And again, last accounting cycle we just had a general journal. That was for sole proprietorship, one person owning a small mom and pop kind of store, kind of place. Whereas a partnership is going to be a little bit larger of a business. It's going to have a lot more transactions on a daily basis. So therefore, we have to break down our transactions into different journals. and then we'll continue on with the accounting process or cycle through posting it to the ledger and creating different forms such as income statement and finding out our profits and losses compared to our expenses. So that's chapter 10. I'm assuming that I assigned you all of the on your owns for 10.1, 10.2, 10.3, 10.4, and also the application problems at the end of the chapter. The mastery problem will also be done as part of the assignments in this chapter as well. If you have questions, definitely refer back to these videos or this video when it comes to the general journal and posting transactions to the general journal. And come into class and be ready to work on these assignments.